this like I had intended to yet. So reading through the chapters and just doing that.
Okay. You want me to start with the bonds then?
Yeah, I think that's the chapter I had the most difficult on, but like now that I reread it, it seems like it wasn't so difficult, but I still
Okay, well,
had trouble.
let's see what we have here. Okay, where are the bonds? Okay, the bonds. Okay, we have actually we had, that's chapter 10, I guess. Chapter 10. Okay. Now let me share, as I like to do. I should move this stupid thing out of my head. Okay, here we go. Chapter 10, my friend. All right, I trust that you can see the
Yes.
the video here. Hold on. Make it nice and big. Oof. Okay. First of all, you should be pretty good with present value, correct?
Yeah.
Present value.
We didn't really future value much, did we? Or
pardon me?
do you do much future value or just mostly?
No. And I'm gonna make a commitment that you're not gonna get future value questions on the test.
Okay.
And the reason is, I mean, you know what future value is. You know, if you have $1 today, 10% a year from now, you have $1.10. And the trick is being able to look at a future investment and know what it's worth today, so we can determine whether or not we will make that investment. Okay.
Right. Okay.
So armed with that, let's see what we have here. We talked, you know, in next chapter, we go into raising money with stocks and bonds, with stocks only. Here we're talking bonds, a bond, okay? And bonds have advantages because they're debt, not equity. You're not giving away any of the company, Brianna. And the interest you pay, at least it's tax deductible. And I don't think you needed to go to school to understand the third bullet. The impact on earnings can be positive if you can borrow low and invest high, right? If everybody could do that, everybody would be rich. But there's some problems with bonds. If you don't make those interest payments, you could be pushed out of business because the bondholders can come after you for failure to pay a legal debt, unlike dividends, which never have to be paid, okay? And you always have the cash flow issue of paying the interest and ultimately the dividend. We should be good with these different terms, right? The principal, that's the amount you borrow. The coupon, stated rate, or the interest rate, the nominal rate. This is the rate that we're going to pay. That's used only for one thing, Brianna, to compute the cash interest. Coupon rate is the cash interest. Market rate, we're going to use that to get the total interest, which includes the amortization. Couple of terms here. Nice low-hanging fruit for the test. Secured bonds, collateral, right? I go to a bank and you say to me, I'll loan you $1 million, Bob, as long as you sign over the property that you have that's worth $1 million. Secured bond, unsecured bond, there's no collateral. Callable bonds, these are bonds that can be retired by the issuer in the future in case interest rates go way down. And convertible bonds, you can call up the bond people and say, turn them into stock in your company, okay? And bonds are rated according to risk and other factors. We don't get into risk in this chapter, but here we go. Face value, we just talked about that. The maturity date, when the bond needs to be repaid. The interest rate here is 10%, date of the bond. What you don't see on the bond is the issue date or the market rate. The issue rate or the market rate. And we need to understand that if the market rate, I just don't like this grid here. If the stated rate is less than the market rate, In other words, if everybody else is paying 6% to borrow money and we're only paying 5%, we are not going to sell that bond for 100,000. We're going to get a number less. And that difference is called a discount. Similarly, if the stated rate exceeds the market rate, everybody's going to want to buy our bond and they're going to pay more than $100,000 for it. And we're not going to worry about bonds. Bonds issued at par. You don't have anything to amortize. Isn't that easy? You debit cash and your credit bonds payable, and you don't have to do a thing except pay the interest twice a year. Nothing to amortize, okay? So let's look at it now. I'm going to go fairly quickly, Brian, okay? So I'm counting on you to jump in if you have a question, okay?
That works. Thanks.
Bonds issued at a discount. The market rate is 12%, and it looks like we're only paying 10%, is what I hear the rumor is. And here it is right here. The market rate is 10%. Our bond pays 10% or 5% twice a year. So to get the issue price of the bond, we need the present value of the principal and the present value of the annuity, which is $5,000 over 20 periods. Okay. I think you're good with that, Brianna.
Yes. Yes.
Okay. All right, Lena, thank you. So anyway, issued at a discount. So this means that you're not going to get 100,000. You're only going to get 88,530. The difference of 11,470 is called a discount, and it must be amortized. And the discount is a contra liability account. So the cash number is the cash number. Whatever the issue price was, you debit cash. You, of course, credit bond payable for the entire $100,000. And the difference is the amount that's going to be amortized. And it's called a discount in this case. And you have two ways of amortizing. Two ways of amortizing. Straight line, which is easy. You have $11,470 discount divided by 20 periods, 574 per period. And isn't that easy? You're going to write the same journal entry 20 times. You are going to debit interest expense for 5,574 because the cash interest is 5,000 and the amortization is 574. And that's a nice clean look, huh? Everything is nice and linear. So let's look at the correct method, the method that we really should be using. The effective interest method is theoretically preferred. Here is our formula. Never forget this little formula. Net book value times the market rate equals the total interest. I'm going to say that again, class. Whatever the book value of the bond is at any particular time, multiply that by the market rate, and that's going to be your debit to interest expense. The credit will be to cash for the cash amount, and any difference is the amortization. So here we go. Well, look at this. We have the same exact numbers, huh? To start off. And we're going to have the same journal entry going here. Let's hold on. They went ahead on me. I hate when they do that. Ooh, that's annoying. Hold on one second. I want to show you well, okay. All right. What I wanted to see here was we would debit the cash for 88,530. We debit the cash for 88,530. And I'm showing it up here now. And we would debit interest expense for, we would debit cash for 88,530. We would debit the discount for 1170 and credit bonds payable for $50,000 or $100,000. So let's take a peek at our sheet here. Remember how to do this, Brianna? 88,530 times the market rate, which was 12%, divided by 2 equals your total interest expense. This is your journal entry. You debit every 6 months. We're going to debit interest expense. We're going to credit the discount, and we're going to credit cash for $5,000. Notice that the interest expense goes up every month because the book value is growing every month. Thus, this is the preferred method because we're truly matching the expense and interest against the timing of it. So you do this for the next 10 years, 20 periods, and you end up at the bond balance of $100,000, and you pay that back. Zero coupon bond. There might be maybe a multiple choice or true or false or so on this. Zero coupon bond. They don't pay interest. How about that? They don't pay interest. If this was a zero coupon bond here, you would pay $88,000. These people would borrow 88 from you, and you don't pay anything back until the end. And you'd pay, in this case, the 100,000. Zero coupon bonds. I don't think people buy them too much. I don't see much of anybody talking about them in the news or anything. They usually pay a much higher interest rate, though, because you're not getting a steady stream of payments. So we just went over how to issue a bond at a discount. Let's take another look at a premium. A premium. The important thing to remember is here, our market rate is 8%, and it looks like we're paying more than that. We're paying 10%. So look what happens here. Holy cow. The public is going to clamor to buy our bonds. So we're going to get a cash amount of $113,592. We are going to credit bonds payable for the 100,000. Now they show it on this one, 100,000, and credit bonds, premium on bonds payable. Here now, the net book value starts at a higher number than 100,000, and we're going to work the number down over 10 years to 100,000. And I'm going to skip through straight line again. Real quick, take another peek at the effective interest method. Effective interest method. Net book value, 113,592. So the starting premium is 13,592. The differences are 100,000. Net book value, 113,592 times the market rate divided by 2 equals 45.44. The difference between the cash amount and the total interest expense is that number there. That number there. And we might retire a bond. You're going to retire a bond by paying back the $100,000 plus a penalty maybe for an early retirement. And the difference would be in cash. So that's a fairly quick look at Chapter 10, bonds. Anything you want to comment on, Brianna?
No, I don't think so.
Okay. All right. Let's go into Chapter 10. Chapter 10. Chapter 10.
We just did chapter 10.
Say what?
I think we just did chapter 10.
Hey, who's the professor here? You're right. I'm looking for chapter 11. I'm sorry. I don't have chapter 11 racked up yet, but so I'm going to go back to chapter 9 if you don't mind, okay? Let's not forget that we have a nice chapter 9 to look at. Chapter 9. Oops. Have a little goof there. Chapter 9. Chapter 9, okay? This is where we have some more questions that are be on the test in terms of some multiple choice more. Okay. Debt is riskier than stock. We know what a current liability is. Oh my goodness, what happened there? That's ugly.
I don't see anything.
Oh, I haven't shared it. I'm so sorry. Thank you.
That's it.
Boy, Brianna, let me thank you for pointing that out quickly, because I sat through one class for an hour before someone said, "What are you talking about?"
Oh, no.
They could, they couldn't see the screen. Yeah, chapter 9. Debt's riskier because we have to pay it back, unlike stock, huh? We know what current liabilities are. We know what these different types of liabilities are. We know there shouldn't be anything on payroll on this test because we have an entire course in payroll. Excuse me. Let's find stuff. Plus in 110, there's a lot on payroll. Deferred revenues, notes payable. Okay. Well, here we get into notes payable. We borrowed money. Toyota borrowed 100,000 at 12% for 2 months. 12% per what, Brianna? That's important, this question.
What?
The interest rate is 12%, right?
Yes.
That covers what period of time? 2 months, since they're borrowing for 2 months?
Oh, right. So
12% per year.
2% total. Over that.
Yeah. So you have to say to yourself, 12% per year, that's $12,000 per year, or $1,000 per month. So the interest is $2,000. Don't make the easy mistake of taking the interest rate and thinking that's the rate for 2 months. It is not. It is not. What do we have here? I'm not worried there. Here's some, I'm going to call it again, low-hanging fruit in terms of contingent liabilities. You either record them, disclose them, or ignore them according to these rules here. And I'm not going to go through this in any detail now. This is kind of thing you guys can look at on your own. But I will say the only time you record a liability is if you know what the amount is roughly going to be and you think you're going to lose the case. Okay? If you think you're going to lose the legal action where someone's suing you, and that's what we're talking about here, lawsuits. Someone sues you and your lawyers say to you, we're dead. We can't win this case. You have to record that as a liability and set up the, record the expense, the liability. If we're being sued on something totally stupid and frivolous, if I get sued because my first name is Bob and some other Bob says he's the only one allowed to use it, he's obviously a lunatic, you can ignore it. Anything else you disclose in the notes. The notes. Working capital. Current assets minus current liabilities. That's a very good measure of whether we can pay all our short-term bills now. It's a measure of, let's call it liquidity. If you have more current assets than current liabilities, technically you're a bit insolvent. Okay. Long-term liabilities, leases. There will be a few questions on leases. I'm pretty sure. Make sure we understand the difference between an operating lease, which is an expense. Operating lease is an expense. Every month you're going to debit lease expense, credit cash, or whatever. Capital lease, you own the equipment. You own the equipment, so you are, quote, capitalizing it, meaning it goes on the balance sheet as an asset. And know these 4 rules. 4 rules. If the lease term is 75% or more of the asset's life, you bought it, not rented it. If you get to own it at the end of the lease, you bought it at the beginning. And if you can get it at a sweetheart deal, you own it. And the 4th one, present value to lease payments is 90% or more of the fair value. The key thing here is operating leases go on the income statement. Capital leases go on the balance sheet based on one of these four rules. Not all four, just one. Long-term notes, Okay, now they're just talking a little bit about bonds. They're telling us we're going into chapter 10. And here they're just giving us the basic concepts of present value. I know you're good with this, Brianna, but I'm going to take the class through it a little bit for just a moment or two. Present value. In 25 years from now, if we invest $100,000 at 10%, in 25 years, we'll have $10,834.71. How about that? Isn't that wonderful? This $10,834.71 is the future value. That's called the future value. And I don't think we're going to have any questions on future value. We want to concentrate on present value. So what we're saying to ourselves here is if we invest $1,000 today at 10% in 25 years, we'll have $10,834.71. Okay, so what? Well, what it means is if we have this possible investment starting, if I walked up to this guy and I said to him, hey, buddy, I'll give you $1,200 right now to take this investment off your hands. Would you take it? The answer is, yeah, you'll probably take it because he's giving you more than what the present value is. You know, if 1,000 grows to 10,834, you know, 1,200 is going to grow to way over 10,834. Consequently, if someone says, I'll give you 900 for it now, you would probably decline unless you were desperate for money right now. Okay, so understand present value and understand that we are going to use the tables, the present value tables. You have one for a single number, and you have one for an annuity. So you have two different tables. Single number, annuity. Know what an annuity is? You better know that, huh? The annuity is simply a series of payments at the same amount, at the same interest rate over a period of time. Time value of money. What's the present value of $100? If we want to get $100 in 2 years, assuming interest rate of 12%, how much money do we have to have in the bank today? And the answer is $79.70. This number here, 0.797, equals $1. You see this 826 equals $1. All of these numbers equal $1 in present value terms. Present value. And here, how much do we need to invest at 10% if we want 1,000 in the future? We want $1,000 in 3 years. How do we do it? We're going to go to the table. The table. 10%, 3 years, 751. So I'm of the belief that the entire class should be comfortable understanding present value and how to use the table. Here's an annuity. An annuity. What is the present value of $1,000 each year for the next 3 years? We want to be able to collect $1,000 a year. Excuse me. I lost my train there. Hold on. Let me get rid of this. Now I can see what we're doing. We want an investment that pays $1,000 a year for 3 years. 10%. We need $2,486.90. Okay. Present value. Let me take you through this one here. If you were in my classroom, I love to give this problem out. Okay. Now, you're not going to have a big problem to do on this exam, obviously, But they might give you this information and they might say, what's the interest expense in the second year? Well, what's happening here? Starbucks bought a truck, delivery trucks, and the deal is Starbucks gets the trucks delivered at the beginning of 18, but they don't have to pay a penny. Isn't that great? They get the trucks free for 2 years. And at the end of 2 years, they make a $200,000 payment. You are not going to debit trucks for 200. You're going to debit it for the present value. Because if Starbucks got a phone call today from Mac Trucks and Mac said, listen, I want my money now. I don't want to wait 2 years. Starbucks would not write them a check for 200. They would write them a check for 159,440, and everybody would be happy because that's the present value. So we're going to take that present value, 159,440, debit credit, and now we're going to multiply it by the interest rate, 12%. So you're going to debit interest expense. And notice what we're crediting, notes payable. So at the end of the first year, the notes payable balance went from 159,440 to 178,573. We're going to take that number and multiply it by 12%. And we're going to have interest in the second year that's higher because the present value kept growing. And now the note is up to $200,000 and we pay at the end. So on the test, you might get a question where somebody made a deal like this. What was the interest in the second year? 21,429. An annuity and a single payment. I'm going to skip this because this is a bond. Okay. All right, Brianna, I'm going to dig up the one chapter I didn't grab for some reason. Okay, so give me a second here. We want chapter 11. Chapter 11. Okay, is it right here? Oh, good. Oh, that's 110, chapter 11. Oh, for Pete's sake. Ah, here it is, chapter 11. Okay. All right, let me share if I haven't shared. Chapter 11. Okay. So we're good on the bonds and the present value, huh, Brianna?
Yes.
Okay. I just needed to hear your voice once in a while, so I know I'm talking to somebody. All right, class. We just learned in chapters 9 and 10 that a company can raise money by borrowing. And borrowing has certain advantages, disadvantages. One advantage is you're not giving away any part of the company. An advantage is at least the interest payments are tax deductible. The disadvantage is you better be making those interest payments. If not, you can be thrown into bankruptcy when people sue you for not paying, okay? Ooh, that's ugly stuff. Okay, chapter 11. The advantages of a corporation. It's easy to become an owner. You know, you could call a stockbroker right now, buy 100 shares of Coca-Cola. You're an owner, okay? Easy to sell your ownership. Corporations have limited liability, unlike sole proprietorships and partnerships. So corporations can own assets, they incur liability, can be sued, do all kinds of things. Ownership. The stockholders own the company, the shares. Who owns the stock? They own the company. And the stockholders elect the board of directors. And the board of directors decide who the president of the company is going to be. And then the president might pick his own people down here, okay? Shareholders own the company. Authorized shares, here's some terms on the test. Authorized shares. That's the amount that the state allows a particular company to issue. It can differ from company to company, from state to state, from sector to sector, the type of business. So here we go. This company had, say, 1 million shares authorized. That's what this big pie is, 1 million. Well, they issued 500,000 or 500,000. They issued half of the shares. Those shares are now owned by the public. They're owned by you and me. We now own half of this company. The unissued shares, if you will, have not been sold yet. But look what happened here, huh? The unissued shares are still 50%, but this company has purchased back 25% of its own shares. Those are called treasury shares, treasury stock. Companies will dabble in buying their own stock back from the public. They bought it from you and me well after it was issued. Earnings per share, I'm going to go past that. We did this in our FSA. Common stock, basic voting stock, ranks after preferred stock only in that preferred stock people get paid a dividend before any money can go to the common people. Again, the board of directors sets up decides what the dividend will be. Par value, no par value stock. I don't think we're too interested in that. Some states in certain situations allow no par value stock. Okay, it just means you have no paid in capital at the time of the issue. Par value has nothing to do with the market value. Nothing to do. If there are two similar companies and one has a par value of 100, one has a par, let me fix that, I'm sorry. One has a par value of 100 and the other has a par value of $1. Does that mean you're better off buying the par value that has the $100? No, those par value numbers are meaningless. Companies can put whatever they want there. We have an equity section we learned about. Remember, going back to the beginning of the chapter, the guy who had the business with the lawnmower or something, delivering pizza or something. Well, he put his own money into the business and business debited cash and credited capital. That's contributed capital. Well, so is a stock issue. We're issuing stock to the public and collecting cash. That's also contributed capital. So we have common stock, and hopefully we got a lot more than the par value. And then you have good old retained earnings here, which is zero when the company comes into existence and then increases or decreases every year based on whether they made a profit or a loss or issued a dividend. So income and dividends are what goes through retained earnings. Initial public offering, the first sale. So let's go through this briefly. Here we go. Sonic issued 100,000 shares of 1 cent par value. They got $20 a share. In other words, when Sonic released the IPO in the first day of trading, the public valued this stock at $20 per share. That's what they were paid, $20. So 20 times 100,000 is going to be 2 million, I guess, if I did that right in my head. So take a look. 100,000 shares at a par value of a penny, $1,000. Cash we brought in was 2 million. The difference goes into this account, paid in capital in excess of par value. The only thing you do with the par value number, the par value per share, is multiply it by the shares, and that becomes the common stock line on your balance sheet. That's all you do with the par value. The common stock line has to be a multiple of the par value times the shares. Secondary market, again, that's you or me. Sonic issued stock to the public. The public bought it. And the public's ownership is called the secondary market. So you bought 100 shares of Sonic, you can sell it in 2 seconds by clicking on your computer or telling your broker to sell the shares. Stock issued for employee compensation. Not going to get into the politics on this, although it drives me nuts. Companies sometimes buy their own stock back for various reasons. That stock that they buy back, they're buying it back from you and me, from the secondary market. It's called treasury stock. And let's understand treasury stock. Treasury stock has no voting rights and dividend rights. It's not even an asset. In fact, it's a contra equity account. So Sonic reacquired some of its shares for $20. Okay, they reacquired 100,000 shares at $20, huh? You debit treasury stock and you credit cash. Be aware that treasury stock is not an asset. In fact, it's a contra liability. When you purchase that stock, you reduce the equity in your company because you can't call your own stock an asset. Sonic can't go out and buy their own stock and say, look how smart we were. We have this beautiful $2 million asset. It's not an asset, it's your own stock. You debit and thus reduce an equity account called treasury stock. But Sonic waited and the stock went up to 30. So now they sold the stock for 30. Now we're talking. They sold the shares for $30, $300,000. The treasury stock was purchased, if you remember, for $20 a share. So they credit treasury stock, which actually increases their equity, and the paid-in capital in excess of par also raises the equity. Dividends declared by the board of directors, not legally required. Companies never have to pay them, never, until they make a formal declaration. If Sonic's held a press conference and announced to the world, we're pleased to announce that we're raised our dividend from $1 a share to $1.25. As soon as they do that and declare they're going to pay it, they have to pay it. You declare it, you credit dividends payable, right? Or cash. No matter what kind of dividend it is, stock or cash, you must debit retained earnings. Retained earnings. These dividend dates are important. The date of declaration is when the liability is made. The date of payment, that's pretty easy. That's when you pay it. And there's another important date in between, the date of record. This date of record is the date in which the owners of the stock will get the dividend. In other words, we're paying this dividend on April 20th, but the date of record might have been April 15. So if you own the stock at the end of April 15, you get the dividend. If you don't own it, you don't get the dividend. The ex-dividend date, there can be a workaround of 2 days. I'm not going to get into that too much. But the date of record is simply the date where you in the accounting department are going to get a list of all the stockholders and how many shares they own. And those are the people who get paid. Stock dividends. Stock dividends. This is pretty basic. Stock dividend. You own 100 shares of stock at $1 a share. And then you get a little notice in the mail. You open it up and it says, hey, congratulations, you got 100% stock dividend. Well, you no longer own 100 shares at $1. You now own 200 shares at 50 cents. Stock dividend. It has really no effect on anything. It's just a reclass within retained earnings. You're going to debit retained earnings because, as we know, you always debit retained earnings regardless of what type of dividend it is. And in this case, you credit capital stock. Small dividend under 25%, large dividend over 25%. The difference is the large dividend, you will work with the paid in capital account. The small one, you will not. Small dividend, you record it at the market sale of the stock. Here, you're recording it at the par value, okay? And I'm not going to go through this long thing here, other than to make this point. This is an example of the impact of a stock dividend. Follow the math with me, please. The total equity is $3 million. If Sonics declares a 10% stock dividend and the current market price is $15 per share, well, let's see what we do here. 10% times 100,000 shares times $15 equals $150,000. This 150 is going to be distributed between the common stock and paid in capital. That's a long-winded way of saying, look at your numbers up there. I see 300, 1,000. Look what happens afterward. The preferred stock we didn't touch. Now there is 1,100 shares, and you have a difference here. Paid in capital went from 1999 to here, and earnings went down, retained earnings. Look at your total equity. It's still $3 million. Stock dividend has no impact on anything. Companies give stock dividends away psychologically when the stock hits a higher price, is up in value, to attract more buyers. Some small investors tend to avoid a stock that's paying, say, $200 a share. They say, oh, I can't afford to buy 100 shares. Well, if they issue a stock dividend and knock the market price down to, say, 50, then maybe they'll jump into the pool. Of course, they can just buy a partial share, but psychology. Stock split has the same impact as a stock dividend. Same impact. You had 100 shares before, now you have 200 at half the price. A stock split does not require an accounting entry. There is no transaction needed for stock split. And if you're interested in knowing why, it's because the board of directors decided to change the par value to match the new shares. That's all. Preferred stock, no voting rights, but that has a fixed dividend rate. A preferred stock is almost like a bond. You look at a preferred stock certificate, it'll say $100 par value, 8%. That means that stock pays $8 a year in annual dividends. So par value on a preferred stock is meaningful. And you have the cumulative and the non-cumulative. And that's important to understand. Because on a test, you're going to get some multiple choice questions where they're going to say, what is the dividend in the second year on this class of preferred stock? And you have to understand if it's non-cumulative, it means that no prior year dividends are paid. But if they're cumulative, you go back in time and catch up. And only then can the common stock people get paid. Common stock dividends on, common stock dividends on preferred stock, okay? So they're starting us off with the common side. We have 110,000 shares at a penny a share. Okay. Well, these people are not going to get a dividend until we pay the preferred stock people. So we have two classes of stock. 3% times 100 is $3 per share, or $6,000 a year. This is a par stock, half the value in terms of par, but it pays 6%. 6 times 5 is 30. So this comes out to $3 a share as well. So the preferred shareholders in both classes get 2,000 shares $2,000 in dividends per year. Now, no dividends were paid last year, and the board of directors only has $50,000 to give away. How much will each class of stock receive? Here we go. We have the cumulative. Cumulative means you go back in time and catch up on the past years. So let's take a look at this. We have the cumulative. So the current year is 2,000 shares times $3, 6,000. But they were 1 year in arrears. They had dividends in arrears. So they have to pay 12,000. And what's left for the common stock people, right? What's left now is 38. But you had that second class of stock, which was non-cumulative, meaning you're only going to pay the current year. 2,000 times 3 is 6. We have $32,000 left to pay the common stock people. The outstanding shares are $110,000. It comes out that the common stock people get 29 cents per share. So they didn't do too good when it comes to the dividend. But keep in mind that the common stock is where the money can really be made in terms of a rising stock price. If the company starts doing very, very, very well, they're going to be able to pay gigantic dividends, hopefully. Well, the preferred people are still only going to get the 6,000 each year. That's all they're going to get. They're not going to share in any capital gains. This common stock might have gone up to $100 a share, and you got a dividend of $50 per share. Common stock, that's the stock that we're normally talking about. Restrictions on dividends. You got to have the money. Legal capital. Who knew? And that whips us through chapter 10. Questions, Brianna?
Nope.
Are you out there in television land? Okay. All right, let me get rid of chapter 11. Oops. Okay. Chapter 11. Chapter 11.
Well,
We just did, right?
Mhm.
Chapter 12. I'm going to continue with the the appendix, because that's sort of in the same ballpark as these prior 3 chapters. Okay. Custom slideshow. Can you see it now?
yes.
Okay. All right. Now here, this was the trickier chapter, I think, huh? The appendix. Have you spent much time looking at this chapter, Brianna?
No.
Have you spent much time looking at chapter 12?
Well, I did it. I just need to reread.
Okay. No, okay. I'm kind of teasing you a little bit. Yeah. I know you've been doing this work. Appendix A. This used to be a full chapter. I don't know why they turned it into appendix. By doing so, all they did was confuse me. Oh boy, here we go. Take a deep breath. A company may invest in the securities of another company. What are we talking about? Sonics maybe goes out and buys shares of General Motors. Well, General Motors makes cars. There's nothing to do with Sonic. But Sonics has excess money lying around, and they determine that it might be a wise investment to buy 1 million shares of General Motors stock. Depending on how much of the company they bought, it's either going to be called a passive investment or an significant influence, or they bought enough to control the company. So you have 3 different categories with 3 different sets of rules. Passive investments. If you own less than 20% of the shares of a particular company, you are totally independent of that company. You are an investor not interested in controlling or influencing the other company. You did so to get dividends or maybe sell the stock in the future when the price goes up. Those are passive investments. Okay? Passive investments. Keep in mind that all debt are passive. All bonds are passive debts because you don't own any of the company. If you go out and you buy $1 billion worth of Coca-Cola bonds and you don't like the way the company's doing things, if you threaten to sell those bonds to influence Coca-Cola, they'll laugh at you. They say, what are you talking about? We don't care if you sell them. It has no impact on Coca-Cola. It's just a loan. Equity is different. Significant influence. If you purchase 20 to 50%, we'll say just over 20 and just up to 50%. Now you're said to have significant influence. And this means that the ability of the investing company, you can have an impact on the other company. You can turn to somebody sitting next to you, you own 45% of the company. You could turn to me, I own 5%, say, and the two of us get together and suddenly we've taken that company over. Significant influence. And then the third is if you buy more than 50%, well, now you own the company. Now you can do whatever you want with that company. You can put it out of business and sell it. You can run it yourself. You can do whatever you want. You can fire everybody, or you can just keep the business going as a subsidiary. Let's look at debt securities. We know that debts are passive, and we just went through a chapter on amortizing bonds, so we're not going to worry about that. We're going to be speaking in this chapter now on stock investments. So what's new in this chapter is we are going to buy a stock for, say, $100. And at the end of the year, the stock is now worth 120. We are actually going to increase or write up the price of that stock to meet the market value. This is the first time we're doing that in this course. Up until now, I pounded into everybody that everything on your balance sheet is at historical cost. This is one exception. And the reason is, you know exactly every split second of every day exactly what your investment is worth. So the AICPA and the came up with a FASB, I guess a long time ago. It said, since we know what the number is, why not adjust to it every month, every year, whenever you close? You can't do that with land or buildings or equipment because you really don't know what the carrying value is. But here we know exactly what it is. Two types of investments: passive, trading securities. We buy some shares of a company, 10%, and we say, we're going to be trading this stock maybe frequently. We're probably going to sell it in a year. In fact, we might sell it in a month and buy it again. And available for sales, AFSs. Here, we tell the world we're buying an asset and we're going to probably keep it for a while. The treatment of these two items, trading securities and available securities, are exactly the same in terms of recording your entries. The difference is at the end when you treat the net income. And that's the only difference, huh? Here we go. Security. We're starting with an AFS. So these are the guys who are going to hold it for a while. They bought 15,000 shares. That's a big chunk of shares, but it's not significant influence. So Graham Holdings has no influence over this company. So are they trading securities available for sale? As soon as you see they don't plan to sell immediately, that makes it an AFS, available for sale security. So your first journal entry is not too tough. You debit this asset account called investment in General Motors or whatever it is, and the cash. this company might pay a dividend. And this is one beautiful dividend, huh? You're telling me you bought a stock on January 5th, and then 6 months later, they're giving you a 15%, big dividend. This is pretty nice. But the journal entry is pretty easy. You debit cash, credit dividend revenue. That's not so tough. It's basically what we've been doing all along. But now the price went from $10 a share down to $8. At the end of the year, we know the price is $8 because that's what the stock market is telling us. So we now have to record this reduction in our asset. This asset is no longer worth 150, it's worth 120. So look at this journal entry, please. Our investment went down. We're going to credit it. We're going to debit an equity account, and an equity account, other comprehensive income, but it's an equity account called net unrealized losses and gains. So what have we done here? We've reduced our asset and we've reduced our equity. Nothing happened on the income statement yet. Okay. Well, look at this. The stock went from 8 up to 11 a year later. So now we were carrying it at 120, went up to 165. So we're going to debit the asset for 45 and credit the equity account called net unrealized gains and losses. Okay. Now we sell the stock. Now we sell it. Man, we did good with this investment, huh? After 3 years, it's up to $195,000. We were carrying it on the books at 150. Let's look at the journal entry. Now, here is where you're going to see the difference between the two methods, okay? Keep in mind that all the journal entries we just went through here for an AFS are the same with the trading security. So I'm going to concentrate on what the difference is between the two. Look at what we see here. Remember that account. We started off with 0, and the first year we had a loss of $30,000, right? This is the period where we credited the asset to show the reduction in the asset, and we debited equity here to show the reduction in equity. So at the end of the first year, this account had a balance of a debit, 30,000. Next year, remember, went from $8 to $11 a share. Now we have a balance sitting in that account of $15,000. This amount will be removed when the sale entry is made. Here we go. How much cash did we get? 195. What was the balance in that net unrealized? It was a credit of 15. Okay. And we now have a investment in AFS securities that we were carrying at 165. And the 45, we got that by balancing the journal entry. 195 plus 15 is 210, 165. Okay. That is a 4-line journal entry, 4-line journal entry to record the sale of an AFS. Now, trading securities, you're going to look again here. I'm not going to go through them again, but the journal entries are exactly the same as an AFS. No difference. No difference. Oh my goodness. The stock went up, it went down. Now it's up to 11, remember? Now, Graham Holdings sells the shares. They sell these shares for the same $195,000, the 15,000 times 13. Remember, we had a 4-line journal entry to record the sale of the AFS. Look at this. Look at this entry. It's only 3 lines. How did that happen? Well, we have the same gain. We have the same cash, and we credit the asset for 165, but here we're only showing a gain of 30. Why is that? Inquiring minds want to know. Please take a look at what happens with a trading security. Remember, just like the IFS, we started with 30,000, right? Then we had a loss of 30,000. But we don't carry that balance forward. See what we did here? We got rid of this where we credited the net unrealized account to get it down to 0. And then the next period, we had a $45,000 loss. And again, we zeroed it out. The only difference between a trading security and an available for sale security is that with a trading security, the net unrealized account is zeroed out at the end of the month and put right into the income statement. So that's why when you look at this account here, you see only a gain of 30. Under the other method, you would have shown a gain of 45 here, and you'd have a fourth line here with the $15,000 balance left in the net unrealized. Trading securities, okay. Let's go through significant influence. Significant influence. Now we're going to use a method called equity. Trading securities, we just went through were fair market value method. Here, we bought maybe 30% of a company. The rules are entirely different. If we have significant influence, we're not going to worry about unrealized gains or losses. The investment carrying amount is adjusted for dividends received and a percentage share of the income. Let me please say it this way. Significant influence means what happens to the parent company happens to you. If they make a profit of $1 and you own 40% of the company, you just made a profit of 40 cents. If they issue a dividend, they debited retained earnings, right? Reducing their company's value by $1, and they credited cash, and they sent you a check. And you debited cash, and you are going to actually show a loss in your equity, even though you received cash. Because what happens to the parent happens to you. You get a check in the mail. Yeah, you're going to debit cash, but you're going to also reduce your equity like the parent company did when they debited retained earnings. Okay. With significant influence, one thing that makes it a little bit easier is you only have two journal entries to worry about: to record the percentage of the net income or loss and to record a dividend payment. Graham Holdings bought 40%. Oh my goodness. So they own $400,000 worth of iNews. They are clearly in a category of significant influence, and they're called an affiliate. That's a new word, an affiliate. An affiliate is a subsidiary, if you will, of a company. Let's talk in terms of KEYT television here in Santa Barbara, Channel 3. That is an affiliate of WABC TV, headquartered in Midtown Manhattan, New York. That is an affiliate of the parent company. So, investment in affiliates. When you're in equity, you're dealing with affiliates. I could imagine a question on a test that might say, you bought 40% of such and such a company. What account do you debit? And they might say treasury stock, passive stock, whatever. You debit investment in affiliates. Well, look at this. iNews made a profit of $500,000. What happens to the parent company happens to us. So we get 40% of that. We get 200,000. And look at this, our asset went up 200, and so did our income. Now I'm going to hold my breath while I say this. Equity in affiliate earnings is not an equity account, it's a revenue account. Why they call it that, I'm not sure. But equity in affiliate earnings increases your revenue. It will increase your stockholders' equity, of course, but by recording revenue, not by recording a credit directly to a capital account. Graham Holdings credits equity and affiliate earnings and income statement account. What happened to the parent company? They had a profit. We have a profit. We got a check in the mail for 40,000. Well, that's nice. We got 40,000. But that meant that our investment went down 40,000, right? Because the parent company, when they issued this dividend, they debited retained earnings, which reduced their equity. They sent us a check. It's just like sending a check from one part of the company to the other, really. Dividends are not revenue under this method. They are treated as a reduction of the investment accounts. Recording investments of the equity. Okay. Finally, let's go through an investment of more than 50%. You own 50% plus one share of stock. You own the company. You don't just have influence, you are the company. You can do whatever you want with this company. You can vote your 50.1% shares of stock to do whatever you like. And why do companies buy other companies? Well, we have three different things here to talk about a little bit. They might do it for what's called horizontal growth, vertical growth, or synergy. Horizontal growth means a line going from left to right, okay? What it means is General Motors buys Ford. Well, that would be some merger, huh? General Motors buys Ford. Ford and General Motors are in the same business. That's horizontal growth. And then that merged company buys, General buys another company, or another auto company. Maybe they buy Toyota. That's horizontal growth. You're buying companies that do what you do. You buy those companies because you are just would love to get a hold of their customers and introduce your products to them. You want to sell both your products and the purchase company's products. You think there's some growth there. Vertical integration up and down. Think of Ford Motor Company buying a glass company. In other words, you're buying a component of what you're building. Ford might buy a steel mill, and Ford will make it so it can then have control over that process. Rubber company. Horizontal, companies in the same area, the same business. Vertical, people who provide you with parts of your needs. Synergy is the notion that 1 + 1 is 3. I have $1 million company and you have $1 million company. You look at my company and you say, Bob is an idiot. He's running that company into the ground. Yeah, they're $1 million company, but they could be 3 million if they had somebody who knew what they were doing. So you buy my $1 million company, and by your superior management, you turn it into a $2 million company. Synergy. Okay. Mergers and acquisitions, huh? Mergers or acquisitions. Mergers and acquisitions. Consolidation, you buy more than 50%, okay? Consolidation, merger. The acquiring company is a parent. The company being bought is a subsidiary. And this is just an aside. When you're doing transactions between you and the subsidiary, I mean, you're the same company, right? But when you buy something from them, they sell it to you. Those kinds of liabilities need to be eliminated. And that's an interesting world. And when you get into UCSB or a four-year school, I bet they're going to have a little class just on consolidated financial statements. Goodwill, we're going to do some goodwill hunting. It's the price above the fair market value of the company you bought. You bought a company and you thought the fair market value is $1 million, but you paid $1.5 million because that was what you had to pay to get that company, which you desperately want. Okay, so Graham Holdings bought out iNews. iNews is now gone. They're gone in terms of being a separate company. Now, that doesn't mean that people lost their jobs. It just means that Graham Holding calls the shots, and they can either continue to have iNews management run things. Hopefully that's what's going to happen. We don't want to see anybody lose their job. Or they can fire everybody, do whatever they want. The key thing here, guys, is goodwill. When you bought this company, when Graham Holding bought this company, they determined that the value of the equipment was $350,000. iNews might have been carrying this on their balance sheet at just 50 because they bought it a long time ago. Now, when Graham buys it, they are allowed to debit their balance sheet for $350,000, which is the fair value of that equipment. Graham Holdings went out and they did some surveys and they talked to people and they came up with these fair values, equipment and patents say. So assuming that these are the only assets this company has, the business assets are worth $950. And of course, when you buy another company, you pick up their debts. So we subtract this liability. So they just paid $1 million for a company that's worth $850,000. The difference is called goodwill. It is an intangible asset. So let's see what we have here. Okay, we gave this new company, we gave that company $1 million to go away. And we picked up their liability of 100. The equipment was worth 350, the patent 600, and the goodwill was 150. Goodwill. A merger, let's not worry about a merger and a consolidation, pretty much the same thing for our purposes, okay? So that is a look at chapter appendix. I keep forgetting that I just had the appendix out here. Very painful. All right, Brianna, I look forward to your comments here on this chapter.
None.
You know what I just realized, Brianna?
Yes.
I don't think I'm recording this session. But that's okay. Let's finish this. I'll do it myself later. Also, I have a couple other earlier ones I did. So this is just for you and me, I'm afraid, okay? So you're good with the appendix, huh?
Yeah.
Or unwilling to discuss?
No questions at the moment.
Here we go. I don't know how I hit that do not video button or whatever the heck it is.
My screen says recording.
Mine says it's not, so okay. Well, hopefully it's recording. Because everybody should get the benefit of my brilliance, right? Okay, you can see the slide
Yes.
now.
Yes.
Cash flows. I mean, this is the one I think you said you worked on a little more, huh?
That's the latest one. Yeah.
Okay, cash flows. This is the one where we want to divide and conquer, huh? Cash flow analysis. Cash flows. We know what cash is. 3 kinds of cash flows that we're going to gather, right? Operating, investing, and financing. Operating is the normal business stuff. Investing would be buying a piece of equipment or buying some treasury. I said treasury stock. I knew I was going to some treasury shares or AFS. Remember those investments? Financing is borrowing. Borrowing, that's all that is. So here is a completed cash flow statement for National Beverage. They are located in Baltimore, Maryland, I believe. And they used to be a big sponsor of the Baltimore Orioles many years ago. I know you're familiar with the Baltimore Orioles, right? Baseball team. Anyway, net income is how you start. So I'm just going to take us through the basic steps here and then go into a little more on the hows and whys of this thing. Your cash flow statement will always start with net income. That's the most operating thing you do. Try to generate net income. That net income number is on an accrual basis. So what we need to do for cash flow purposes is add back all non-cash expenses. In this case, we had depreciation and amortization. So if you think about it, 43 here plus 10 means that our cash generated profit was actually $53,000, not the 43. This 43 came after we deducted these non-cash items. So we've turned the net income from an accrual to a cash basis, essentially, okay? First step. The next step is you go to your balance sheet and you look at you look at only the current assets and liabilities, only the current operating assets and liabilities. And you are going to compare two balance sheets, the difference in the balance at the end of the prior year and the end of this year is going to go into this report. Notice that we have a positive cash flow for accounts receivable. Accounts receivable. Did accounts receivable go up or down, Brianna? Do you remember the rules?
I know it's the opposite, so.
There you go, exactly. If a current asset goes down, it is a positive cash flow because accounts receivable goes down when we get paid. Inventory goes down when we sell it. And we're going to go over those rules some more. If you see if an asset went up, if a current asset went up, that is a negative cash flow. If accounts receivable went up, it means we temporarily gave away our product for free, trusting someone's going to pay us. So operating cash flow, and I shouldn't use this word, but I will, is simply net income plus depreciation and amortization plus the changes in your operating current assets, current liabilities. 1, 2, 3. This is the important cash flow. Operating. This company generated 53 million, or whatever it is, by selling beer, selling soda, right? Now we have some other things they did. They invested in properties and they purchased some property and they sold some property. They had some short-term investments they purchased and sold. The net of that is investing. And look here, they borrowed money, or looks like they paid back money. It looks like they bought some treasury shares and paid some dividends. Those are financing. So that's just a quick run through of what the cash flow statement looks like. Cash flows from operating. Customers, when customers pay us, that's cash flow from operating. If we make an investment in another company and we get paid back, that money coming back is operating. The investment is investing, but the cash we get back is operating. Outflows of cash, well, we buy things, we pay our people, we pay vendors. So we have cash inflows and outflows. Investing, Inflows. We sold some products, not products. Let me change that. We sold some equipment. We bought a bunch of these forklifts 20 years ago, and now they're pretty much shut. We sold them. That's a cash inflow. We bought some stock in Microsoft. We sold it, cash inflow. The outflow is when we bought the forklifts and when we bought the investment. Not too tough concept-wise. Financing. Inflow. We borrowed money. We issued stock. We paid back the money we borrowed. We bought some treasury stock maybe, and we paid dividends to the owners. These dividends are part of financing. This here is the super summary of what we're trying to do. And I'll go into some of the particulars in a moment. What we're saying to ourselves is the cash at the beginning of the period was $18,267. And at the end of the period, it had risen to $29,932. So cash increased 11,665. Okay. At the end of the month, you go into a meeting with your boss and the big shots, and you're spending a couple hours going over everything, and you get to the cash flows. And you say, and the boss might look at this, and the first thing the boss might focus on is this 53 million. He said, wait a minute, we generated $53 million by selling beer, and yet our cash only went up by 11.6. What's going on? And you have to say, whoa, cool off, boss. Don't forget, we borrowed a bunch of money. Remember, boss, we borrowed this 30 million. And also we had to pay back some people. We had to go out and buy some more equipment. And the boss, oh yeah, now I remember. The combination of these cash flows is going to equal the change in the cash. What do you need to do a cash flow statement? You need 2 balance sheets, year to year, and 1 income statement. And here we go. Here we go. This is a first look at the rules. Now, if you don't understand these rules, you're going to have trouble on the test, because there are going to be questions along the lines of multiple choice question, for example, that might say accounts receivable went up $100 and inventory went down $300. What was the cash flow from operations? And you have to be smart enough to know that if an asset increases, it's a negative cash flow. If it decreases, it's a positive cash flow. You don't have to worry about that plus minus line of thought when it comes to liabilities. If a liability like accounts payable goes up, that's a positive cash flow. How come? Because we just brought in $1 million worth of equipment or something. We don't even have to pay for it yet. So that's a positive cash flow. When does accounts payable get reduced? When you pay the vendor. Okay. So make sure you understand these rules about current assets. An increase in a current asset is a negative cash flow. Investing, you buy some equipment and you sell it. Simple as that. Financing, you buy, you borrow, and you pay it back, or you issue stock. Okay. You don't have any of this plus minus stuff that you have with current liabilities, current operating liabilities, and current operating assets. So here is a balance sheet. This is a balance sheet. Remember the 29,932 and the 18,267, and the difference in cash was, I think, 11 something. Well, you need the comparative balance sheet, and you need the income statement for the current year. And we know we start our cash flow statement with operating plus depreciation. So that's an automatic start. We are teaching the indirect method here. The indirect method is the method that the whole world uses. The indirect method is what you're going to see on the 10Ks and the annual reports. The indirect method is what the investing public wants to see. The direct method is just basically taking the cash account and just summarizing a few numbers, okay? No matter what the format is, you're going to get the same results. But the indirect method is the one that we are teaching and that you will know. Net income plus minus the changes in assets, liabilities, non-cash expenses. Let's take a peek. Let's go off on something that we've not discussed yet with the cash flow statement. You might have gains or losses. Now, when I say gains or losses, I don't mean net income or net loss. I'm talking about things like the gain on a sale of an let me think about this. Gain on a sale of a fixed asset. Okay. That gain is already in your net income. Would you agree? We have a net income of, say, $1 million. And that $1 million came from $950,000 worth of selling beer. But we also sold some forklifts and we made a profit of $50,000. That gain is shown on a separate line on your income statement. Therefore, any gains that we have, meaning other gains, you subtract from the net income. Any losses you add. I'll be glad to go into more detail on that. If anybody has a question, you want to email me or anything. But the key thing is gains subtracted, losses added. Here we go. Giving you another look at the rules about the current operating assets. So here we go. Now we compare the two balance sheets and we're going to come up with every one of these differences. How about that? That's not so hard. So let's see what we have here. The cash went up by $29,932. So this is the figure we're going to try to reach. Short-term investments went down, huh? So that's going to be a positive cash flow. If it goes down like this, same thing with the accounts receivable. So let's see. At this point, we know we're going to start with the net income. We're going to add the depreciation, and we're going to plus or minus the 980, the 4680, the 2699 here, and these two changes in net income. And we'll be done with the operating piece. Here's our net income, 43,635. I see depreciation 10,063. That's our start. That's our start. Okay. Now we have to eliminate any gains. In this case, they didn't have any. Take a look at your cash flows provided by operating activities. We started with net income of 43,000. We add to that the non-cash expenses. Accounts receivable went down, so it's a positive cash flow. Inventory and prepaids went up, which makes it a negative cash flow. Accounts payable went up, which is a positive cash flow. In a perfect world, accounts payable would go up and up and up and we never pay it. Huh? Well, it's only positive until you pay it. And accrued expenses went down. So that's a negative cash flow. So we just finished what I think is the harder part of the cash flow statement. And again, it's just three things: income plus depreciation and the changes in current assets and liabilities. The rest of it, you don't have to worry about stuff like plus minus or whatever. So here we're going to get into the next area, which is okay. So I'm sorry, I got lost for just a second there. What they're telling you here is something we kind of know already, right? A common rule of thumb is Avoid firms with rising net income but falling cash flow from operations. Investors will not invest in a company if they don't believe the cash generated from operations is sufficient to pay them dividends or expand the company. Nobody's going to lend money if they do not believe the cash generated from operations will be available to pay back the loan. You know what company is showing pretty good profits now, but they're still hemorrhaging cash? Tesla. Tesla's making good net income numbers, but they're not selling enough cars to generate positive operating cash flows. In case you're interested, Tesla right now is making a lot of income selling carbon permits. Without getting into great detail, companies who pollute quite a lot must buy carbon credits from companies who don't pollute much. So Tesla's an electric vehicle, not poisoning the air. Maybe a steel mill is still spewing smoke in the air. They buy these carbon credits from companies like Tesla. So Tesla's making money doing something that's not in their operation. If you want more information on this subject, you can talk to me or talk to somebody who really understands it, okay? Okay, so we finished, right, with the current assets, current liabilities, and we worked with the cash and the beginning net income plus the depreciation. Now here, what they're telling us apparently is we have two investments, two investing cash flows. Now, you remember when we did the accounts receivable, the inventories, etc., we just put this number down. That was the cash flow number. Here, you're not going to see the 980, and you may not see the 1999. And let me show you why. And it's not terribly difficult because we must report individually the cash used to purchase, and then on the next line, the cash we paid for equipment. Unlike accounts receivable. Accounts receivable, they don't want us to show how much we sold and then how much we collected. We don't care about that. Here, though, we do want to see detail. And I call this picking the bones. What I mean by that, you are going to be given this information in terms of the general ledger, or they're going to tell you. This is something where you just put the numbers in, okay? So let's talk to me.
I think we're stuck on a different slide.
Uh-oh. Okay, did I share chapter 12 yet?
Yeah, we're in 12.
Okay, what are you looking at? I'm looking at the one that says consolidated statement of cash flows year ended, and then it has a note on the side.
It says interpreting cash flows from operating. So it was like the last slide, I think.
Really? You and I are looking at different slides? How could that be? Hold on. Wow, that's weird, huh? Hold on. Well, let's do this. Okay. Okay, you see the cover page now?
No.
What do you see right now?
The same one that says interpreting cash flows from operating up.
Okay, let's do this. What I'm going to do is I'm going to close this file down for just a second, huh?
Okay.
Wonder what's causing this maladjustment. Okay, now let me go back and find it again. Okay, Brianna, thanks for pointing that out.
Mm-hmm.
I should give extra credit to students who are actually looking. What chapter are we in? 12, right?
Yep.
Do you see it now, the beginning page? No, I haven't shared it yet, have I?
No.
I don't want to share. I'm sorry. Okay, you see page 1?
Yes.
Okay, let's see what I can do here. Okay, I was going through the cash flow statement. This all look familiar so far?
Yeah, I've done all that.
Okay. You tell me where we went off the track. You remember me showing you the balance sheet and the income statements, direct versus indirect,
Yeah.
and what we need to do with gains and losses? And you saw this part, right?
Yes.
Here's our income statement, and we went over how to put the operating section together. So far, so good?
Yep.
Operating, we talked about don't invest in a company that is not generating cash flows.
That's the last thing.
Although people are buying Tesla like crazy. Is that, or are we still on the operating? We're on the a common rule of thumb line?
That was the thing that I was stuck on. So that's the last thing I saw.
Okay, we're stuck on this, huh? So let's see what happens. Do you see international perspective?
Yes.
Okay. All right, I'll take it up from this point. You see the two green lines they highlighted for short-term investments in equipment?
Yes.
Okay, this is where we were when the screen froze, apparently. Short-term investments. The difference is 980, mean that investment went up, and equipment went up by I'm sorry, let me start again. Short-term investments went down 980, equipment went up 1999. You are not going to see those numbers brought over because we have to show the detail, picking the bones. You have to go into your general ledger for the account that says equipment. And you have to add up all the equipment purchases, which were 12,124, and then you sold something for 62. You see the difference in the treatment, Brianna, from up here?
Yes.
Here, with the current assets, current liabilities, you're just bringing the number over. Here, you have to know the detail. Let's see what they tell us about short-term investments. Although short-term investments is a current asset, it is an investing item. So here, remember that we had that 980, the difference between the investments? Here, we have to show the proceeds, 2443, and the purchase. Not too tough. If you kind of understand that, what we're doing with this part of the cash flow statement, we're just digging into the general ledger. We're grabbing that account called short-term investments, and we're looking at that glorified T account, which is the general ledger, and we're figuring out, well, basically it's the debit and credit side for the most part, okay? And now financing, we borrowed money. We borrowed money. Okay, we borrowed money. It looks like we might have issued stock too, huh? So let's see what happened here. Our long-term debt changed by 22,772. Well, this one's easy because the only activity we had was we repaid debt. So that's pretty clean, huh? Treasury stock, and dividends. Let's see what happened with that. The company repurchased some stock. They bought treasury stock, their own shares, negative cash flow. They paid dividends. Guess what? That is a negative cash flow. So remember I said you pick the bones, Brianna? Here's your retained earnings. You had a beginning balance of 37, and then we had the net income of 43, which we started with, right? The dividends paid were 726. And there you go. You now have the cash flows from operating, the cash flows from investing, cash flows from financing. So this company is doing beautifully in terms of selling beer and soda and Schnapple. What to do that? They've had to borrow like crazy, and they've made some investments that are paying off, hopefully. And there we go. Cash flow statement. Completing the, let me look at this three. Yeah, you have to show this on your financial statements, at least in terms of a disclosure. You have to definitely provide them with a reconciliation of net income to cash flow from operations and the other. That is the whole idea of this chapter. Cash flow statement. Okay. With that, we've gone through everything, Brianna. What are your
Yeah.
thoughts? What would you tell the class? It's your turn to speak to the entire class. I'll let you do that.
Take the practice exam.
Yes, that's very helpful, right? And maybe come to class once in a while, right?
Yeah.
Yeah, that would help. You have any questions on anything that's been here? Wow, we've been here a long time, huh?
Yeah, no, it's just nice to hear it all at once and cumulative, and then
Okay. I'm 99% sure I didn't record, so we'll see. Well, no, it does say recording. Okay, we'll find out. All right. Any other nothing else to talk about then, Brianna?
nope, thank you very much.
All right. Well, you tell Landon I said get that ukulele tuned up, and we'll work together on something. Okay.
Sounds good. Thank you.
Hey, bye now.
All right, bye.